I know that you've told me about this stock before over a couple of phone calls, Fabio, and you're very excited about the stock. It's been around for a long time. It settled into its niche quite well, I would probably say, correct? And that stock is Unum.
Yeah.
And now kind of coming into this, Fabio, what are some thoughts that you have regarding some preliminary ideas that you might have regarding the stock, Fabio?
Well, I'm pretty biased because I have a very large position in Unum that's done really, really, really well. I bought it during the pandemic. I bought it at pretty much almost close to peak pessimism because it is a casualty insurer, life insurer, plan insurer for businesses where they basically insure the employees at every business. So it's business to business. You're not going to get your personal insurance policy from Unum without being employed by one of their customers. And I pretty much saw the numbers, and a lot of people were thinking that they were going to go bankrupt because coronavirus was super, super deadly. And I kind of just made the bet against that. And it turned out really well so far for me. I'm up nearly over 100%. And I've been reinvesting the dividends currently. I actually been thinking about maybe adding. The story could have changed, but I am aware that there are a significant amount of risks. So just know that I do have a position. So I may carry a little bit of bias. I will try to leave the bias out and let the model do the talking, and I will just sit back and just observe.
And so, in this case, I do not have a position in this company. Me and Fabio differ here. So during our video where we go more into our due diligence of this company, I'm going to try to offer more of an unbiased perspective of Unum, in essence. So basically, not saying that Fabio is going to be incredibly biased, but basically, if bias is something that might deter you, I'm going to be as unbiased as possible within our due diligence video itself. So Fabio, kind of what are we looking at here right now? What growth rates are we assuming for this company itself?
So the growth rates, and I can already tell you just by looking at the numbers, the cash flows are being impaired right now because they're paying out for those. So basically, if you miss work because of the disease, the Unum has to make these payments to the business because that's the point of the insurance. So I would have to normalize these cash flows, and that way we can do on the deeper dive. So just note the cash flows are probably like really low right now. But I kind of think this is not a grower. So they're going to grow between 5 and 10%. So I'm just going to go 6, 7, 8, and 10. And actually, let's eliminate the 6 and go to -2% decay.
Nice. I was about to ask for some decay in this. You know, you always like to throw in your occasional decay, Fabio.
And I do expect them to do some buybacks longer term. I do expect them to return to a 2% buyback longer term. Because that's actually a huge part of their capital return strategy on top of the dividend. And the dividend's actually not really, it's not really a problem on a payout ratio basis. So if I take a look here, so everything looks really bad right now. That looks bad. Again, more color. We need to provide more color. This is not good. This is, again, that then confirms my theory. The PE can be deceiving because right now that's a gap PE. The actual cash flows entering business is this. The market cap is this. And the book value, notice the book value is 53.57, share price of 24. Why do I care more about the book value in this instance, Austin? What kind of business is this?
I had to guess because it's an insurance business, a lot more of it. This business is going to be more asset heavy, I would have to guess.
What kind of assets?
Therefore, it's probably going to be a lot of insurance policies based on fair market. I would probably assume. I don't know, Fabio. I haven't looked at the stock yet.
So for anyone who doesn't know, insurance businesses, they take your money and they invest it. So you know that policy every month. They don't just put it in a bank account. That would be silly. They go and invest it into different securities, depending on the risk. They have really smart people, supposedly. that analyze risks and are basically portfolio managers, and they'll invest it in typically bonds, unless you have Berkshire Hathaway that buys equities. And there are insurance companies that buys equities, but we're not talking about those today. One day I'll reveal one of my favorite insurance companies that does do that. But this one in particular does a lot of bonds. So you can more or less, with bonds, you can trust the book value unless you for some reason believe that those companies are, going to default. So usually the more conservative the insurance company, the more higher grade on the credit rating they'll invest in. They'll get a lower yield, but they'll make up for it with either their match of premiums, et cetera, et cetera, et cetera. And they can pocket the difference essentially between what they don't pay out. And on top of that, they pocket the difference on those extra money they make on money. So you want to think about that. So book value, I actually care about book value for these kinds of entities because of that nuance. Again, in our due diligence, we're going to have to see what's going on with this cash flow, but I assume that the cash has these short-term headwinds, and should be noted, looks like a lot of risk, not for
Something else
part
too that I would be interested in seeing in a further due diligence is basically the fair value hierarchy, the fair value structure behind a lot of the assets on their sheet.
Mostly one.
And that's something that I would want to look into during a due diligence in essence. So
yeah, mostly one. All right. So there's probably some craziness going on in the liquidity ratios. We'll cover that in our deep dive, but looking at the solvency ratios, they're kind of remaining the same. Long-term debt ratio is pretty okay. That's deceiving. It's not that low actually, because they're taking their portfolio value into account. Long-term debt to capital, that's better. That's a better look at an insurance business. And then long-term debt to equity, again, deceiving because of the portfolio value. So the assumption behind the book value is after all their liabilities, that's the remainder of all of it. So for example, if UNUM shut down today, supposedly there's about $50 in value, which is double the price, double what the current price is. With added caveats that some of those value metrics we need to look deeper into, but they could be wrong. But as far as the business values them, that is what it is. Okay, so it should be noted that. All right, and then earnings quality, it's great here. Then the events happened, and now it's not good. So we can see that it did affect business operations, but didn't kill the business, at least yet. And we can see here, so price to free cash flow, it tends to follow the earnings per share, but we had an event here. Didn't do so good. Lots of cash has to leave the business to pay out policies. You should be happy that, well, not too happy, but you should be happy that they're honoring their agreements, right? Because that builds trust, long-term trust, that those clients will say, wow, they paid out the policy. This doesn't matter because it's an insurance company. All right. Closing thoughts, Austin, real quick on UNUM.
This is definitely going to be a company that I'm personally interested in doing the due diligence into. I'm going to probably look deeper into this company over the coming days and just really try to come up with some potential caveats that maybe you might be overlooking, maybe potentially not, maybe potentially. That's kind of the reason of why I'm here, Fabio. So
of course. And just so everyone knows, if you can't replicate my trade because I bought at a much lower price. So if you think that it's a good investment for yourself, just know that we're not in the same boat. We are at a vastly different price points, and my risk in the stock is a lot lower than your risk would be should you be buying today. I'm thinking about, or want to do more analysis, whether or not I should add new capital aside from the dividends, right? So that's just another thing to think about. So I hope I wasn't too biased with this. I think I was pretty fair in saying that there's a tremendous amount of risk. It looks really bad right now, but there could be some changes going forward, or there could be some one-time things to think about.